Sound check. Thanks. Oh, what's this all about?
I don't want them. I don't want them earlier. Yeah.
Okay, looks like we're ready to go here. We're running out of time for the luxury of anything except talking specifically about the material that remains. I went to Saddle Rock to try to save the college and failed miserably on Friday. Had to leave because I'm too out of sync with the rest of the college, I think, these days. Anyway, can't talk about that. I've got to talk about put and call options and the forthcoming examination. And I think you'll find this interesting. It's unfortunate that it's pressed right up against an exam because it is really interesting to students typically, but it's also kind of challenging. It's put and call options are complicated. But if you follow me closely, and I'm just holding you to understanding the fundamentals of them, and you read the chapter carefully, which was very carefully written, and uses different examples than I use in the lectures. So between the written material and the lectures, I think you should be able to nail this. Then you'll understand them, and you'll probably understand why it is I use them in this class, because not all introductory classes talk about put and call options because of their complexity. But this is mud, you can handle it, so here we go. This is a reminder about our exam, and I'll start sending out emails and all the things I normally do prior to exams. Our second exam is a week from today on Monday, covering chapters 6 through 9, and all material since the last exam, including options being covered this week. The exam will be structured just like the last exam, except that it will have a matching component as part of the structure. I'll send out an instructional email to students with disabilities on Thursday or Friday. That'll probably be Thursday because I've already written it. I will send out an instructional email to students with course conflicts on Thursday or Friday, as I did before. And this will give you instructions in either case about how you respond to your special circumstances. And that always seems to work very well. If you will miss the exam because of travel or a clinic or some other reason, you have to tell me right away and ask for approval, which isn't automatically granted, but if I think it's a legitimate reason, I'll grant it. And then I will post a review video, as I always do, next Friday or Saturday. And I'm going to post a sample online exam for the matching segment only, if and only if I can find the time. I'm not absolutely promising this, but I'm a little ahead right now, so I think I'll be able to get that out on Wednesday. However, because of the limitation on the number of exams I can give at one time, that'll probably only be up for a day. I'll leave it up for 24 hours. It'll be short. I just want you to see the format that is used for that. And I also want to test how it works, although I have run a smaller localized test with a handful of students already, and it has worked with those students. So we're setting up, and I'll keep reminding you, and if you reasonably well prepared, you should do all right on this exam. Here's a topical issue. This was in today's Wall Street Journal, and I saw it, read it, and I thought, well, this is an example of something that I was teaching them about before. In the bonds section, remember I said that if for any reason a ratings agency downgrades a bond, then it will be affected immediately in the bond's price. And so that happened last Friday when S&P Global Ratings cut Newell bonds to a junk credit rating of BB+. And you can see the impact upon the price. It fell from 106 down to about 102. And it will probably drift lower for a period of time as well. This is just the initial reaction. Again, as it says here, the contrasting bond and stocks. Oh, the company's stocks had a good earnings report. The stock went straight up and its bonds were going straight down, which makes this kind of interesting, but that's not inconsistent. The company's long-term prospects for handling the bond payments without default in the eyes of the rating agency have been diminished, whereas their most recent earnings report was strong. And so, as they say here, the contrasting bond and stock moves highlight the risk bondholders face as low interest rates encourage companies to carry heavy debt loads to stimulate growth. And this is a common story. Almost any time I read about the downgrade of some companies' bonds, it is declared that they are really carrying heavy levels of debt because low interest rates have encouraged them to use that debt to expand their growth. So that's a good example of the application of the impact of credit ratings upon bond prices directly. And again, of the categories of risk that we look at, this one represents default risk. Now, I hope you've had a bit of a chance to read the chapter, because otherwise this is going to be a little hard to digest here. And it's because this is circular material. I have to start somewhere. So I start with the definition of a call option contract in the lecture. And it's loaded with jargon. And you say, I don't understand what any of these terms mean. This definition is meaningless to me. That's right, it will be when you first see it, if you haven't read the chapter at least. But based upon the definition, we look at an example. Then we go back to the definition, and by then you've seen the example of what all the jargon means, and then you understand the definition. And so going back and forth between the abstract definition of the contract, because it's a type of contract, and the example clarifies things. And ultimately, I think people have no trouble understanding options. You sort of sit there and look at them, and you look at the option chain, and you say, okay, I see why that is priced that way. That has been my experience. Students generally do fairly well on the call and put portion of my examinations if they put in enough time to make sure that they understand it to begin with. If you rush in and study at the last second, this is tough material to go through. Okay, a call option, a derivatives contract, is a contract. It's a contract that you enter into implicitly if you trade options, regardless of whether you buy puts or calls or whether you write or sell them. As I point out in the chapter, you're just as likely to buy a call as buy a put, and you're almost as likely to sell a call as buy a call or sell a put as buy a put. This is not where the consumer is on one side of the trade and institutions are on the other side of the trade. You could be anywhere in the trade in put and call options. So if it's a contract, it's a standardized contract, fortunately. And so as a standardized contract, it's actually fairly easy to understand once you see an example. So the call option gives the owner the right to buy the stock from the option writer at the strike price on or before the expiration date. That's the technical definition of a call option. Now, I know that's confusing because you say, well, what's a strike price? What's the expiration date? And so forth. But as we see by example, you will understand this. European options, some of which are traded in the United States and all of which are traded in Europe, allow you to buy the stock from the option writer at the strike price only on the expiration date and not before. That's important because when you model in for pricing, the model has to be different. Something we don't get into in this class, but it's at the heart of material at Econ 136, the modeling class. The party who sells this contract and this right is writing the call. That's the term, you're writing the call. If the party writing the call also owns the stock, he is said to be writing a covered call, otherwise she is writing a naked call. A single contract is always for 100 shares of stock. And you say, you lost me on all of this. That's okay. We'll see it in just a minute. I'll define the put option, then we'll rush to an example, and with that example, it will become clear. The put option is very similar, except the terms are reversed. It gives the owner the right to sell the stock to the option writer at the strike price on or before the expiration date. So you have this right to sell something between the time you enter this contract and the expiration date, and specifically 4:30 in the afternoon, Pacific Standard Time right now, on the date of the expiration. Put and call options are financial assets that are called derivatives. There's two types of derivatives that we study in this class. One are these options, and the others are futures contracts. A derivative's value depends upon the value of an underlying asset to which it is attached. I use in the lecture Cisco call and put options, and in the book I forget what I use in the book, but whatever the example was, IBM in the book. And so the call and put options for IBM in the book, for Cisco here, are tied to the stock price of IBM and Cisco respectively. So in this case, the value of an underlying stock against which the option is written. Now, to see what we're talking about, let's move immediately to an example. And I go to some trouble always to have a very current example, one that is actually within 2 or 3 days of when I give the lecture. And today I actually put this together this morning. So this is today's data. The data in the book's only about a week, 10 days old or so. So this is the options chain that gives us all this information, that gives us the parameters of these various contracts. And you look at this and you say, wow, that's a lot of information there. What in the devil are we looking at? So let's make sure that we understand all of it. At the very top is simply a reference to Cisco's stock information that at that moment was relevant to this chain of options. It's called a chain because there's lots of them. So Cisco at that exact moment had a bid of $47.67, had an ask of $47.68, had recently traded at $47.67 and a half. So that's Cisco, that's its price, and these options are keying off of that. Now, you know enough about this to realize that Cisco stock changes, the bid and ask changes very quickly every moment. And so you say that must imply that this page and all of its content changes very quickly every moment, and that's true. These are changing rapidly in reaction to the change in Cisco stock. It's doing it for every strike price within the chain, and it's doing for every chain that is offered. Here, we are looking at a chain that is defined by the expiration date. Now remember, the contract, whether a put or a call, gives you the right to buy in the case of a call, sell in the case of a put at a certain price on or before the expiration date. So the expiration date for this one is November 15th, 2019, which is Friday of next week. So whatever happens, it has to be concluded by 4:30 in the afternoon, our time, on next Friday, November the 15th. We have until then to take whatever action we're going to take if we have written or bought a call or a put shown on this page. Now, the strike price is indicated in the column where you see the reference strike prices. And we're looking at only a segment of the page. The lowest strike price you can see there's 45 and the highest is $50.50. If I were to print the entire page, the page starts at $37.50 and it goes to $60. We are close to the money or at the money here on this page because the strike prices in the center of the page are close to Cisco's current price. Now the strike price is in reference to the price at which you can buy or sell your respective option. When we take a look at the bid and ask, that works the same way as it does for stocks. You buy and sell options, typically with limit orders, typically at a level 2 type Q, and bid and ask performs exactly the same function that it does with stocks. That's really true of almost all financial assets in general. And we'll look at a specific example. So now we recognize that there is an expiration date. There are an array of strike prices, and in this case, they appear to be implemented 50 cents at a time. So there's a strike price for 45, 45.50, 46, 46.50, and so forth. And we know that we're looking at an expiry, as it's called, expiration date, the short term is expiry, in 11 days on November 15th, 2019. And also, since we're looking at it, we might as well recognize that for each of these contracts, there's two categories of previous trading information. One is called volume, and the other is called open interest. You can see that down there indicated for the 49.5 call. And the volume that I have pegged there is 65. So 65 contracts of 100 shares per contract has been traded this day. And open interest is the total number of contracts that are outstanding and active at 2,775. The book describes when these chains appear by date, and so you can reference that. Once they appear, of course, volume is zero and open interest is zero for everything. But as the contracts are written and people buy them, then day by day the volume rises, but of course the open interest accumulates. Then as we approach expiry, these wind down as people offset or sell out of them. And gradually the open interest declines to a value near zero, and then the clearing markets, the Chicago Board of Options Exchange, clears off the rest of them. It goes to zero, and the contract is done forever. We can see also I'm identifying a region that is in the money and out of the money on both sides, and white is out of the money, and yellow is in the money. Yellow refers, we'll come back to this, well, in fact, every single one of these examples we'll cover at least 3 times. Out of the money means that this option has currently no extrinsic market value. If you tried to exercise it now, it would be worthless. If it's in the money, the yellow shaded area, the market currently has some intrinsic value. If you try to exercise it, it actually has some value, although the value would be below its current market price. We'll come back and take a look at that in a moment. But when I start using this terminology, you'll know what I mean. When I say we're looking at an out-of-the-money option or we're looking at an in-the-money option, at some point you need to understand what it is I'm telling you. Okay. All right. Now let's look at a specific call and then a specific put and match it to our definition. And then you'll understand it better. I can choose any call or any put from off of this page and could have chosen another chain, for example. But using the same page, let's go near the money and choose a call and a put. On the top of this page, we have calls, and on the bottom of this page, we have puts. And I am restricting the choices right now to out-of-the-money calls, and you'll see why I do that. Okay, so what is this page telling us? At the top, we simply have the reference to Cisco so that we remember that these prices are tied to Cisco's price and Cisco's bid-ask. And so we have it there so we can refer to it. This is a segment or cutout from the previous page. On the top, we have the cutout that starts with the 47.5 call and ends with the 48.5 call. So if we go back and can see where that is, it's near the red line on the left side of the page. So I'm only looking at 3 options in that arena. And when we get to the put side, I'm looking at the right side of the page at the red horizontal line. And so the 47.5 call, and we go across there and say, well, it kind of looks like this, say 48 call is like an individual stock that has a life or activity of its own. And that's exactly right. Each of these options is a separate set of financial contracts, separate assets, and of course they're all linked to each other mathematically in terms of what prices they can assume in a competitive market, but they all nonetheless are options that have lives of their own. So we're going to consider buying just one of them. We're going to consider buying the 48 call, and we're going to try to discover why we would ever do that. Again, all contracts are in 100 share blocks, and so a single unit in reference to an option is the right to buy or sell 100 shares of the underlying stock, not one share, 100 shares, all right? So let's take a look at the 48 call. Looking at that 112, $1.12, that says you can buy the Cisco November 15 being the expiration, 48 call for $1.12. We're saying you can buy it because that is the best ask price. And so if you submit it, it will be executed typically at that price. You can submit, of course, a limit order at any price you want, but if you submit it at best ask, you'll be buying it. And we're saying this gives you the right to buy Cisco for $48 per share anytime between now and November the 15th. You say, well, okay, $48 a share, is that good? And you look at the top, and it says you can directly buy Cisco for $47.63 per share now, if you want to. So why would you buy something that gives you the right to buy it at 48, which is a higher price? Well, because Cisco's stock price will go up and down, but this contract right, the strike price, is a constant for you. It means you can buy it on any day at $48 a share. You can buy it tomorrow. You can buy it on Friday. You can buy it next Tuesday or next Wednesday, anytime before November the 15th. So clearly, if Cisco starts to rise above $48 per share, this option will become valuable. And the more it rises, the more valuable it's going to become. That's why you're willing to pay $1.12 for something that currently has no intrinsic value. Now, what do I mean when I say it has no intrinsic value? Again, it gives you the right to buy Cisco at 48, so if you buy it, I can turn right around and exercise it and say, you just do that, as we'll see here in a minute, by clicking the exercise radio button on your brokerage account, and they'll exercise it for you. They will sell you 100 shares of Cisco for 48. It has no intrinsic value, of course, because that's actually more than the actual price of Cisco. But if Cisco goes above 48, I still have that same right, and if I exercise it then, I will get at least the intrinsic value, all right? And so that's the call. Now you look at this and you say, I can kind of see why we would do this. If we think the price of Cisco is going to go up, maybe by a lot, by November the 15th, this would be a smart move, as we'll see by looking at examples here and the range of possibilities in just a minute. But what if you think Cisco is going to go down in value instead of up in value? Then instead you might buy the put that we have isolated, which is the 47 November 15 put, which is priced at $1. Both of these examples are out of the money. Again, they have no intrinsic value currently. Now the 47 put, we read this carefully, and it says you can buy the Cisco November 47 put for $1. That's at best ask. You can submit a limit order again at another price if you want, but that's best ask, and that would be executed immediately, which gives you the right to sell Cisco for $47 per share between now and November the 15th. So this gives you the right to sell it, right? So you say, well, why in the devil would I do that? Well, suppose I think that Cisco is going to go down in value. Suppose I think it's going to go to 40 before November 15th. If it goes to 40, then if it goes to 40, I buy it at 40 and then exercise the option and sell it at 47 for a $7 per share intrinsic value, and of course a profit of basically $6 per share, because it just turns out that our example is $1 per share.
If a stock gets delisted, do put and call contracts still apply?
What's that?
If a stock gets delisted, okay.
The put and call contracts are all organized by the Chicago Board Options Exchange, at least for the options that we're talking about in this class. And they are standardized. And the rules of standardization are discussed in the chapter. So how they set up the expiries, how they set up the strike prices. There are rules for setting the strike price intervals, for example, and they're complicated. I'm not going to ask you to remember them, but because they are so complicated. Well, it's not that they're complicated, they're extensive, right? So some of them are priced 50 cents apart, some are priced $1 apart, some are priced $5 apart, and the like. All right? So at any rate, you've got all these options. Now note here, by the way, that the bid-ask spread on this chain that I've chosen is only a penny. And so therefore the difference between bid and ask is about as narrow as it can be. It will be the case on options that are more remote or deeper in the money or deeper out of the money. The spread between bid and ask widens considerably, and that becomes a bit of an issue when you're trading. So here we're looking at a hot stock trading near the money on a high volume day where the spreads on both the calls and the puts are only penny spreads. We will look at other examples, though, for less popular stocks or expiries that are not chains or expiries, but strikes that are out of the money where the spread is a nickel or a dime or 50 cents or 80 cents. And therefore, we need to kind of keep our eye on the spread. Now, let's stylize this, and to do that, we use this little model. In my case, it's a little Python model that I designed, which allows me to choose an option, use it as an example, and print this graph, all in the same piece of software, right? So this tells you what potential call option values are upon expiration. So this says, look, if you want to know what this option is going to be worth, and you want to know what your break even is going to be given the cost of the option, all you have to do is look at this graph. It takes into account the stock price because obviously that matters. The strike price is going to, in our case, be greater than the stock price because we chose a call that is out of the money. So the strike price is higher than the stock price. The option, therefore, has no intrinsic value. Then the orange line represents the various values that this option will have at expiry at various prices down on the bottom. And it has a profit or loss line that's related to it. And that spread is, of course, simply the cost of the option. And by looking at this, we see, well, this is the November 16. Cisco, this is a different call we're looking at. I'm looking at one that's 50 cents cheaper. This is a November 16 expiry. That probably should say 15 is my guess. Yeah, on the top it says 15, so that 16 is wrong. In fact, let me change that. I'm not likely to use this slide again, but I'll change it anyway. Okay. So that right here you can see it properly. The November 15 expiry, Cisco out of the money 48 call, purchased at $1.12 on November the 4th when Cisco was $47.64. So we go back and look at that one because we weren't looking at it before, and that's the would be just by the 48, right? So we were using, I guess we were using the 48 as an example. That's right. I had originally 48 and a half set up, but it wasn't as good an example, so I changed it. So we've been using the 48 as an example all along. So break even's 49.12, given what we paid for this option. Now you can see why people trade them. The loss is limited. The loss is limited to the cost of the option. The most you can lose on this thing is what you paid to buy it. The gain that you can realize on this is potentially very high. Cisco obviously has to shoot up in value, uncharacteristically, obviously, for you to make a lot of money on this. But if Cisco rises only a little bit, if you know what you're doing when trading these options, you'll make money on it regardless. So you can see that if Cisco, for some reason, goes 50, 52, 54, then there's a big gain on this. And in the examples in the book where I'm using IBM as an example, I'm showing you can invest $1 and the rate of return $12 12 days later or something if you are lucky or talented and are able to choose a stock that is rising in values. If you can see, for example, at 50, if you bought it at, let's choose a good price here. If at 54, the blue profit line tells you that the profit would be about $4.50, about $4.40 or so if you bought the option and it went to 54. Well, for $4.40 profit for a $1 investment is pretty good. The trouble is, of course, its likelihood of going there is pretty low in such a short period of time, unless you have some reason to believe otherwise. We do know, however, that you get severe discontinuities in these stocks, especially around earnings reports, and so they frequently do exactly this. They will jump $5 or $6 a share. Uber's falling $3 or $4 a share as I sit here because they gave their earnings report at 6 o'clock. And as I left my office, Uber about a week ago was trading for about 37 or 38. It closed on Friday at about 36. And it looked like to me it was trading at around 33 when I left my office. So that's a $3 drop on a stock that would be at 36. And whoever has the puts on that, which includes me because we're trading strangles, is making money at least on the put. Now, when we take a look at one more qualification, though, like it says there, this shows only what the option will be worth if held to expiration. And you don't have to hold it to expiration. So this mapping is far more relevant for a European option than it is for an American option, because this is the only chance you have to sell the option in Europe. You sell it at expiry. However, for the American option, you can sell it 5 minutes after you buy it, or certainly the next day. And this, therefore, shows the payoff only if you hold it to expiry. And in many times, your strategy tells you to not do that. So this is limited in what it can tell you about the range of possibilities for profits on American options. Now, if you look at the put options, we're using the November 1547 put, and it works the other way, of course. Whoops, there's also something that does not go there. This is the old graph where this is no longer part of it. Okay. All right. So here we have the stock price again in green, the strike price in red. The options value here rises if the price of the asset falls. And in this case, because the option was exactly $1 by coincidence, the break-even is an integer, and it's an integer at 46, because this is a 47 option. So if the put falls in value to 46, then it's at break-even for you, at least in terms of intrinsic value. But again, as we point out, although this is instructive, it shows only what the option will be worth if held to expiration, given the possible prices of Cisco. So then you ask the all-important question, well, how does it behave on its way to the expiration? Can we say anything systematic about that? And we can, but not very systematic in this class. One of the subjects in Econ 36 is to model these where at any moment you can ask what value the option will be using sensitivity analysis, saying if this, then that. If the price of the stock is this and the volatility of the stock is that, then this is what the option will be, and that's profitable or not profitable. We can tell, however, I keep this example from last year because it's a better example than anyone I could conjure up this year. Let me read the inset here to make sure that you understand this point. The previous slide may give the impression that one will make a profit only if the option finally goes above the strike price for the call and below the strike price for the put, which it did, of course, in that example. But logic tells you that as an out-of-the-money option call option approaches the strike price, the call will rise in value even though it is still out of the money. Generally, if the price of the stock goes up, the value of the call will rise also, so long as no other variables change, like volatility. So if you say under normal circumstances, if nothing is really shifting around, then if the price of the stock goes up, then the price of the option will go up with it. The question is, therefore, how much or by what degree? And that's the modeling question that one has to answer. Now, here we're looking at an example so you can plainly see this from last year. This was November 2nd of last year when Apple plunged. This year, Apple rose in value, and it didn't rise by nearly as much as this example, so I retain this example. Now, this is a one-day reaction to options that I'm pricing on November 16th, 2018. So what we're looking at here is not the value of the option at its expiration. We're looking at it simply the day after we perhaps purchased the option. Now you can see this is motivated by what happened to Apple during the earnings report. You can see Apple near the top is about 222. It didn't fall a lot, but it fell to about 210. So a $12 decline in value for a $222 stock. And these stocks have these discontinuities during earnings reports. As I said, Uber's going through one. Yeah, Uber's going through one right now. I was thinking maybe it's Lyft. Lyft was last Thursday. Uber's going through one right now. Well, looking at the Interactive Brokers quotation page for this option chain down here at the bottom, although I'm sorry, it's kind of hard to read, although there's a better example in the book that's quite a bit easier to read. You can see if you look at the percentage changes of the value on the call side, those are all in red. And the percentage changes in value on the put side are all in green, which means the puts rose in value, every single one of them in the chain, and the calls fell in value in reaction to this decline in the price of Apple stock. And those percentage changes they're showing are only a one-day reaction. It was the day after the earnings report, and they're large. The one on the top for Apple, for the 200 Apple put, that put rose in value that day, and that day only 81%. So it nearly doubled in value. If you take a look on the other side at the calls, then you can see down near the bottom, some of the calls fell in value by 88%, and the ones at the top fell in value by 60%. And so those are sizable moves given this considerable decline in the price of Apple. So, of course, American option traders will often trade with the intention of getting out of the trade much earlier than the expiry. And those graphs I showed you are not really relevant for the strategy that is used for trading American options. Basically, you want to jump into a call if you think the price is going to go up by any magnitude, and you want to jump into a put if you think the price is going to go down by any magnitude. And even if it happens during the day that you enter the contract, if you're disciplined on entering the contract and trade correctly, and that's a huge if, then if you're simply right about the direction of the stock, your call or put will behave as you expect. Now, there is a statistic that indicates the sensitivity of an option to the underlying price, and it's called the delta in option jargon. The delta is the first partial derivative of the price of the option to the price of the stock. It turns out that when a stock is exactly at the money, the delta is 0.5. And that means if the underlying security rises in price by 1%, the call will rise in value by about 0.5% of its own price, and the put will fall in value by about 0.5% of its own price. So one of the biggest components of options modeling, if you trade options, especially if you algo trade options, is perpetually calculating the delta at every moment for any option under consideration. What is the delta? You are asking your computer program, because the delta tells you, again, the sensitivity of the price of the option to the price of the underlying. Ultimately, after that, it becomes fairly simple to keep in track, right? A call is if it goes up, a put is if it goes down, and the sensitivity is measured by the delta. Then you just have to deal with the price. So that should be understandable to you. Now let's talk about this in the money, out of the money distinction here a little bit more, because I've told you what it means, but let's take a look at a little bit more information, more revealing information. Okay, a call is in the money if the strike price is less than the stock price. In the money means it has current intrinsic value. Normally, if you've just bought it, the intrinsic value is less than you just paid for it, so there's no reason to sell it, but it has some value if you exercise it. If it's out of the money, it is out of the money, I should say, if the strike price is above the stock price. That has no intrinsic value, and if your option expires out of the money, it expires worthless. If your option expires in the money, it expires at the value of its intrinsic value, which you'll realize either by exercising the option and then disposing of the stock, or simply selling the option back to the exchange on the expiration date. For the put is, of course, reversed. It's in the money if the strike is greater than the stock price. It's out of the money if the strike is less than the stock price. At the money refers to the closest to the money, and near the money is the same expression. Some accounts or brokerages use ATM, others use NTM. ATM means the one closest to the money. Near the money means very close to the money, and sometimes includes 3 or 4 prices. And so when we ask our question, in the money, out of the money, it's always, what is the intrinsic value of the option? What's the option going to be worth if it is exercised at this moment? And out of the money has no intrinsic value. Now the call's intrinsic value, of course, common sense tells you, is the stock price minus the strike price. Because if it's a call, you have the right to buy it at the strike price. You can immediately sell it at the stock price. And you may say to yourself, well, do you actually do that? Do you really mean to say you can actually buy it and sell it? Yeah, I do it all the time. It's actually done by computer, where a computer buys it and sells it. Right then, instantaneously. It does one before the other, but it does it only a few milliseconds apart, as long as it takes it to execute the command. And so it indeed is done this way. You exercise the option, buy the stock, sell the stock, all in less than a second in some cases. If you do it manually, in less than, say, 5 seconds or 10 seconds, depending on how fast you are. And the premium is the option price minus the intrinsic value. So by example, I know this is a lot, but it's kind of common sense, actually, if you think about it, right? Of course, the option's worth the difference between the strike price and the current market price of the stock. That's not something that is difficult to figure out would be true. And of course, the price of the option is going to be higher than that because you're paying for the possibility that it can become really valuable in the future if, in the case of the call, the price goes up. So naturally, this sort of arrangement that I'm describing here is the way this is going to work. Did you have a question? You'll have to...
Wouldn't what the option is worth to you, wouldn't it be...
You want to come up
the
with...
difference between the strike price and the stock price, don't you also have to take into account the amount that you paid for the option?
I need to stretch my legs anyway. So, say that again.
So you have the difference between the strike and the stock price.
Right.
But there's also the amount of money you paid.
There's 3 prices,
The
right?
option. So don't you want it to, wouldn't it make sense if it's in the money if, the strike price is greater than stock price plus the amount that you paid?
No, just 3 prices, and keep this straight. Okay, so one is, the strike price is a contract price. It gives you the right to buy something at that price. The stock price is whatever it is. Okay, the price of the option, you'd say, perhaps, without thinking about it first, is the spread between the two, but it's not. The strike price of the option is whatever the market values that contract at. And the strike price of the option is always going to be higher than the intrinsic value of the option because, of course, it gives you the right to make far more money than the intrinsic value of the option. So if you have a strike price that's $1 above the stock price, and it's a out of the money option, well, by example, it would be, it's going to cost a lot more than $1. And that's because if the stock goes up by $10, that option is worth $9. So somebody's going to pay a lot more than $1 for that right. If you've got 2 or 3 weeks for this to go well above. So those three prices are going to exist, but they're very systematic in how they relate to each other, right? And this slide right here, the next slide, not this one, tells you systematically how that works, or how it should work. At least in a common sense way, it should appeal to you. Well, yeah, of course that's true. Okay, so let's take a look at the premium. Okay, now first of all, if an option's out of the money, then the premium is simply the option's price, because the premium is the spread between an option's price and its intrinsic value. It's the difference. This is what you're paying extra for the option because it might, in the case of the call, rise in value. So if we look at this 47 call, which is deeper in the money than any example we've looked at yet, this option's ask, this option's premium is equal to the value minus the intrinsic value. And I have that written in such a way that you can sort of look at it separately. So you say, okay, the stock price minus the strike price for a call is the intrinsic value. This is a 47 call. This one's in the money, right? So it has intrinsic value. This is a 47 call, and the price of Cisco is $47.64. Now here we're using the ask. And so it has 64 cents of intrinsic value. But it's not selling for 64 cents, it's selling for $1.66. That's more than it's worth at the current time. And that spread, that difference, is the premium, and that's $1.02. Why does it have that $1.02 value? Because at the moment, this option is not worth that. That's because we have between now and November 15th for this option to rise in value. And you will always have the right to buy this stock at $47 per share. So if it rises to $57 per share, the intrinsic value is no longer 64 cents, it's $10. And because that's true, people are obviously willing to pay this premium to access that right. And systematically, this is going to depend upon a lot of things. It's going to depend upon how long we have before the expiry. The longer the expiry, the higher the premium. How deeply we are in the money, typically there, the longer the deeper in the money, the lower the premium, and the like. So on the put, then the options price minus the intrinsic value defines the premium. So if we're using the example of are we using the 48 or the 46? That's not right. That example was not right either. And I lost the example. Here it is. This is the 48 put using last year's. Okay. Okay, so for that example, that's the 48 put. We have the arrow pointing at the right put, but the example wasn't right. Okay, so the options price is $1.45, but the option's intrinsic value is 36 cents. So the premium on this option is $1.09. You're paying $1.09 more for the option than its current value. So the premium, therefore, matters for in-the-money options, and you explain it by understanding that this option can become much more valuable than it is at the present time. And this price is reflected. And you say to this, well, yeah, okay, I see. It's $1.09 in the bottom case. It's $1.02 on the top. And the market determines that, right? Absolutely. This is entirely determined by the market, supply and demand. Is there any logic to it? the actual determination of price, given that it's market determined. The logic is absolutely massively impeccable. It's purely mathematical, and it's determined by, God, millions of computers out there that are constantly calculating what it should be for every single option in existence. So it's no coincidence that it's $1.09. I would be able to tell you that it should be $1.09 even if I didn't see the quote, based upon the models that I use. This is an extremely modeled environment where the models determine, based upon the probability of this stock going various places, it says, yep, the price of that should be above $1.07 and below $1.12 or $1.11. And you look at it as $1.09, you say, yeah, it's a pretty efficient market. These models, in fact, demonstrate that these kinds of markets are extremely efficient. You very seldom find pricing anomalies in these option chains. And when you do, you trade on them. And that trade is, again, the form of arbitrage that brings these models back into, brings these prices, I should say, back into alignment. Okay. Now, by the way, on the Thursday lecture, by example, we kind of go back and refresh our memory about some of this stuff. Buying and selling options online, not a problem. Let's say I want to buy the December 13, I'm using a different example here, December now, 48.50 call marked below in the diagram cut from my TD Ameritrade account, and that's on the next page. To buy this option, if I submit a market order, it will be bought at ask at $1.28. So you can see, I want to buy the 48.5 call for Cisco. Maybe this is real. And I haven't bought a Cisco call in a long time, so it's not real, but perhaps I'd be persuaded to do this because I think Cisco's going to have a good earnings report, or something good is going to happen to Cisco. Or the market's going up as a whole, it's going to carry Cisco with it. Whatever it is, I've got a reason perhaps for buying the call. So I say, you know what, I want to buy a cheap call, so I think I'll buy the 48.5. That's close enough to the current price, so it could easily go in the money, but it's less expensive than an option in the money or one that's even cheaper, and this matters, right? So I say if I buy the Cisco call for 48.5, I'll pay $1.28 at the most. If I buy the 48, it's $1.52. If I buy one in the money, the cheapest in the money is $1.78. So I want to buy the cheap one. I decide to buy the 48.5. I could also buy the 49, but the 49 is further and further away, and I want one that's going to end up in the money if I'm right. So I choose the 48.5. Now, I've got a bid and ask that I'm looking at, 124 to 128, and I say I've got to choose a limit order price. I know that if I submit the limit order for 128, it'll be executed instantly, and I'll get it for 128. I mean, the rule of thumb, of course, between bid and ask, if you're buying using a limit order, the highest price is the price you bid, and you get it at that, right? And if you're selling, then the lowest price is the price you bid. So in this case, we know if we submit a limit order at best ask, we get it for 128. If we keep forgetting whether it's bid or ask, we know that the higher of the two prices is what we have to submit, and we get it for that. Like I say here, though, there's a spread, though, between bid and ask here. That's why, by the way, I chose the December option. These don't have penny spreads anymore. You can see the one at the top has a 3-cent spread. The one, in fact, all three of these, the one that we're looking at has a 4-cent spread. The one above it has a 3-cent spread. Now it starts to matter a little bit more. At some point, we'll get to where they have dime spreads or 15-cent spreads, or for less popular stocks, spreads even larger than that at this price. So there's a spread between bid and ask, and I should really submit a limit order ask or below, but I may not. But if I set it below, it may not get executed. So I can either submit it at $1.28, know it's going to be executed, or I can submit it at $1.26, which is splitting it right in the middle, with the so-called peg. 126 right in the middle. Save it 2 cents per share, but on the other hand, that is a savings. But I can also put a limit order in at $1.20. If I've been watching this thing sort of sine wave through the day and it looks like it's going to dip back down below $1.20 again, then I'll put it in at $1.20 and save myself not 2 cents a share, but 8 cents a share Obviously, though, if I put it in at 126 and certainly at 120, it may never be executed because best ask has to go down to that price for that to happen, and that obviously may not happen. So the limit order is what you want it to be based upon the same sort of reasoning that you would use if you're trying to buy a stock, right? Now, this is what the order page looks like on TD Ameritrade. If you are deciding to do this at $1.20, this is what I would have to do. This is a limit order to open 5 contracts of Cisco, December 13, 48.5 call at $1.20. So I said, okay, I got single order Cisco, I got buy to open, I'll come back and explain that. 5 contracts, that's 500 shares equivalent. The expiration December 13th, the strike is 48.50, it's a call. And given the bid-ask spread over here on the side, I'm going in below both best bid and best ask at $1.20. And this is a day order, which means that if it's not exercised by the end of the day, it's going to be canceled. So I might get this, I might not get this. And the further away I am from the current market price, the less likely I'm going to get it. But that's all that is involved in making the options trade. So you say, well, what was that buy to open? Well, remember, I told you could write the option. Who did you buy the option from? You bought it from someone just like yourself who wrote it instead of bought it, because you also have that option. If you own Cisco, for example, you might want to write a covered call. And that is the right for some other party to buy Cisco from you at a price that is currently higher than the market price. I wrote a covered call on AMD last week just to show you as an example in the class, and it was exercised. So I'm going to show it to you in the next lecture. So I already owned AMD, and I said, I'm going to write a covered call way above the money at 33 or 34. AMD at the time was about 31. And I got $1.75 for it, which is nice. It's an option that expired in 6 days. And that's quite a rate of return. I get to pocket the $1.75 for AMD. So I wrote it, and it was actually exercised after AMD's report. I was kind of hoping it wouldn't be exercised so I could easier to show you the paper trail if it wasn't exercised, but it was. So buy to open, this is if you're buying the call. To open means starting this contract. When you are done and want to sell your call, for whatever reason, then you sell to close. What about these other two, sell to open and buy to close? You do those if you're writing the call. So if instead of buying this Cisco 500 share block, or the equivalent in options, if I was selling this option to you, and I wouldn't use the price of $1.20, I would use the price of $1.30 or $1.26 or something like that. If I were selling it to you, then I would sell to open, and the offset to get out of the contract is buy to close. You say, why would you do that? Well, I just explained why you would do it. I sold it in the hope that, in this case, Cisco doesn't go up to that price, and I get to pocket this. What do you get to pocket? Well, I get to pocket $1.32 per share. And you say, well, is that good? Well, yeah, it is pretty good if you think about it. Cisco is trading for 48. Not as good as it could be, not as good as the AMD example I'm going to show you. Yes, $48 a share. And I can pocket, let's say I write the, let's see what I've got the option here. I don't think I've got very many choices to show you. No, I don't have the puts here. Got to go back a little bit. Now let's see, we write the 48 put. That's the same example. No, it's not. 48 put for Cisco. Okay, 48 put for $1.45. Okay, so let's see, that's the one I write instead. Write the 48 put. So I could write the November 48 put, the one we were using as an example a moment ago, and I would get $1.45 for it. And you say, okay, so that's $1.45 rate of return. That is definitely mine. I keep that forever because I have no intention of ever selling that put or canceling it. That's profit for me. What's the rate of return? Well, it's $1.45 divided into 48 bucks. Well, that's not very high. It is for 6 days because that's what it's for. If you annualize that, it's a 40% rate of return, right? So if you're writing the option, it's pretty high. The actual rate of return is like 4%. and or 3% or whatever it is. The example in the book I give you on IBM, right? The 6-day or 8-day or whatever rate of return on writing options is 8% or 6% or 4%. But the annualized rate of return, if you just keep doing it over and over and over and over and over again, is considerably higher, typically well above 30 or 35% for some stocks. I trade AMD because the characteristic annualized rate of return on writing options that are covered calls on AMD is almost 60% per year. So, but there's a risk on that, as I point out. If the stock plunges in value, then that's kind of an absolute loss, right? So this has got to be for a stock that is holding its own or is rising. So again, you can write the call because you think the price is going to hold steady or go down, to you who buys the call because you think the price is going to go up, right? And so, as I say, although large institutional traders write and buy calls and puts, small retail traders also write and buy on a horrific pace. I think probably much higher volume, I should say, than they do for stocks. There's an interesting Reddit sub on options where people discuss their multi-legged, complicated strategies and whatever, and this just rages every day with multiple entries. I sometimes post an entry if I see a posting that I think is one that I really agree with or one that is wrong. Now today I made 4 of these kinds of trades. This is the IB trade ticket. It's for November the 4th, 2019. This is what it looks like on Interactive Brokers. And on the top is, you can see the buy sell, and you can buy to open, you can buy to close. This doesn't specify you need to know what you're doing on Interactive Brokers, or you can sell, which means you can sell it covered, you can sell it naked, or you can sell it to close if you had previously bought it. And I was selling, on that transaction up there I wasn't. The ones down at the bottom are already sold. And so you've got your bid ask, you've got your limit order, your quantity, and so forth. Then if you trade manually, there's a confirmation screen that pops up, and that's the one in the middle to make sure you're not doing something wrong. It's really easy to do something wrong. It's really easy to accidentally sell it instead of buy it because you're in a rush, or to have the wrong volume, or to have the wrong price. There's a million different things you can do wrong in an options trade. So traders who are mistake prone like me have confirmation pages that pop up and say, listen, idiot, this is going to cost you $12,000. Are you sure you want to do that? And I go, oh, no, I meant, oh, I forgot there's 100 shares. So I didn't mean that I wanted to buy 100 options contracts. That's 10,000 shares. I only meant to buy one. I've done that before, actually. So yeah, limit, where it says up there, quantity 4, that's 400, not 4. And so if you think that 400 it should be there. Actually, in Econ 136 2 years ago, I had a student in the class. And in that class, I had people come up to the front of the class because it's held during market and buy and sell. Well, it's projected on the screen where everybody else watches so they can see how limit orders work. And everybody's all freaked out and everything because it's the first time they've ever done it. And 2 years ago, in putting in the order, I wasn't paying close attention, and she put in an order thinking that the quantity was per share. So she put in an order for 100. It was supposed to be for 1. And she said, is that right? I looked at it. She said, yeah, that's right. But I didn't notice that she had the quantity at 100. And she hit the submit thing there, and this big red sign pops up. This thing here turns red when you're doing something that's really not so bright. And, it said, you don't even have $100,000 in your account, What are you trying to do, buying 100 option contracts? And so we had to dial it back and change the 100 to 1. And that happened actually live in Econ 136. So you can do this kind of stuff. Now, down on the bottom is all the stuff I bought and sold on SPY today. So basically, bought and sold 400 contracts at these various prices we're showing there. And this was actually the tail end of a strangle that was quite profitable. So as we'll see here, I'm going to explain after the exam, don't have time now. The earnings strangles were ultimately unprofitable because of the big loss I took on Google. This one, though, is nice and profitable, and I just traded out of it this morning. But I don't trade using this. I trade using these Python programs right here. So basically, I can't make the mistake because of the way the Python is written. Although I say, warning, running this program will place a live order. Do not put the wrong information in here, especially for order size, which I've done also inside this program. So in this one, I don't even look at bid or ask. The program does it, and it places a peg in between bid and ask that is following a pegging formula that I use that is pretty much guaranteed to execute the option at a price that is better than best bid or best ask. And so all 4 of those trades were done with these kinds of programs. So this is a Jupyter version. I usually run the non-Jupyter version when I'm actually using it. The Jupyter version I have for Econ 136, so I can show people how you set this kind of thing up. So algo option traders, of course, therefore use the programs to submit the orders. And the reason, by the way, you have to is because when you look at the live feed, these things are bouncing up and down so fast you can't figure out what best bid and best ask actually is, especially for SPY. It just, thousands of transactions per second flowing through there. And so the best ask price will be bouncing around across a dime level just as fast as you can read it. So your computer program has to freeze it at a point in time. And this is why I use Ethernet connection, right? You can't even use a wireless connection to do this. It freezes at a point in time, figures out the peg, and sends that limit order out within just a few milliseconds. And then it gets to the brokerage, and probably, 600 or 700 milliseconds. Whereas if I was a real algo trader, it would be a fraction of that, like 200 milliseconds is the difference between somebody who has a decent internet connection and somebody who really has a setup, right? So again, in the background is automation of all this stuff, makes it kind of interesting. Now this is informational. This is the closest weekly. And here I'm showing you almost the entire chain, but not the entire chain, to show you that there's a lot more than out there than what I'm looking at, that we're looking at. You say, oh yeah, this is IWM, right? No, this is Cisco still, okay. So, but the reason I have this up here is to show you that as soon as you get away from the money, which is right in the center where the yellow switches to white and the white switches to yellow, then your open interest and your volume drop off. And as you can see, that's where the spreads get ugly. The spread there on the 39.5 call is 780 bid, 850 ask. And that's where you have to trade with algos. You have to figure out how to finesse a price in that 70-cent spread to trade that. And you say, well, would you ever trade those? I trade these a lot, actually. They're way out of the way in the deep in the money options for indexes, as you'll see on Thursday, and other traders trade them a lot too. That's mostly what you were looking at here a minute ago. Those options were way out of the money when I first bought them, and the puts still were, but the calls were in the money. So the dream came true. I bought a call that was way out of the money, and SPY shot up today into the money, and that's why I made money today. So again, though, the point of this is no volume, wide spreads, very little open interest, and it's a different class of trading than trading right around the center. You see, right around the center, you have massive open interest. The first out-of-the-money call has 5,023 contracts outstanding and has a volume of 925 in just this day alone, right? The ones that I'm looking at there at the top have no volume, and one of them has no open interest. That's going to trade differently than something that's near the money. Now, we tend to trade indexes a lot because they have a lot of volume. And so here is a option chain for IWM, the Russell 2000. I've traded that quite a bit. Not right now. This is for today. Now, you'll also notice that when you look at all the chains available, and by the way, again, the chapter has a lot more about this than the lecture does. This is all the Cisco stuff that's out there right now today. I don't know how many that is. It looks like about 12 or 13 or 14. On the right is all the spider chains available for today, right? So the ETFs for the indexes have massive chains. Everywhere you look, there's availability. And they're much higher volume and much higher open interest, which is why When you're learning how to algo trade this stuff, you usually start with the ETFs, like IWM, SPY, DIA. You trade those three for a while until you get used to this. Now, some pointers about this. I can see, yeah, I'm going to probably have to stop here. Even I was trying to rush today. I was hoping to get through this, but there's no way in hell that's going to happen. So I'll stop with this. Pointers about option trades. There's a large spread between bid and ask, and this really cuts into options trading profits, or it can if you're trading in that domain. In options trading, a trading strategy is absolutely everything. You have to be a very disciplined trader. You have to have a very explicit strategy. That's why algos work well, because you code your strategy and you just blindly let the algo trade it. And there's no decision parameters on your part at the time of the trade. Those are all made when you build the algo. You never, ever, ever use a market order for an option trade. You check open interest and volume for liquidity. Now, the one hard thing about trading, if you ever try to do it, and trading options among the young, as I refer to you since you're 50 years younger than me, is a big thing. You know, trading on Robinhood is a stupid thing to do. Robinhood has very poor execution on options. Crazy to trade options on Robinhood. But you can trade options on the free account in TD Ameritrade or on Interactive Brokers now, and they have good execution. It's good for you to trade options when you're young. You'll lose every penny you've got, guaranteed. I'm telling you right now, you will. But it's a really cheap education. It's a lot less than hearing me lecture, because I figured out once. Actually, the per capita cost of me lecturing is quite low, because my classes are so big. But it's still expensive for you to hear a lecture. But if you lose $500 on trading options, it's probably worth it, because of all the things you learn that you shouldn't have done that you won't do the second time around. The difficulty is, if the option becomes profitable, figuring out when to sell it, because you just want to make a little bit more money, especially when it goes to 0.7 delta. And you say, wow, man, I only traded $1 for this. It's worth $4.50. And we still got a week to go. Let's, $4.50 is a big profit. Let's sell it. $3.50 profit is like a 3.5 full return. I don't get that on anything I ever do. Now, let's see if it'll go to 6, because if it goes to 6, that's better. And then it goes to 2, or it plunges and falls out of the money and it goes to 0. Right? So this is the problem with options trading. Figuring out when to buy it is not the hard part. Figuring out when to sell it is the hard part, right? Because it's, as you've seen, the stocks are wildly cyclical. It shoots up here and gives you a nice $4 return. You say, oh man, just another $1. And, because you don't trade because you thought that way, then down it comes. And away goes your profit. You say, okay, it'll come back. Sometimes it does, and sometimes it doesn't. So, okay, let's see. I better stop with that because it's 4, and you have rights as students to not be forced to listen to lectures that are longer than those that are scheduled. So come back and do the strategy the next time around. Now, the end part of the strategy is all don't worry, be happy stuff that I tell you just for your own information. So there's very little left in this lecture that you'll need to know for exam purposes.
So when you're options trading, you're basically placing a bet on whether a stock will rise or fall.
Yeah, pretty much.
Isn't that the same thing as just buying or shorting the stock outright?
Isn't that what?
Isn't that just like the same thing as...
No, it is kind of, but it's an entirely different kind of bet with leverage, So the outcome is radically different. Because I can either buy SPY today and hope that it goes up. Well, if it goes up, it goes from 222 to 224. So I paid $22,200, and I sell it at the end at $22,400 and make a $200 profit. Or else I can buy the same option for $6 instead of $22,200, or $600, I should say. And if it goes up $2, then I sell for $800, right? That's why young people like it. To buy in the stock, $22,000 for 100 shares. To buy into the option, $600 for 100 shares. But it has the leverage implied in that, and that's why students lose money. Because you make the smallest mistake and you're wiped out. See, that's the problem. The lecture's over.
Yeah.
I'm just babbling now. So I couldn't tell the difference. Not my problem.
I haven't totally decided which class I'm gonna make pass fail, but if I do decide it's this one, I can just bring it on Wednesday. That'd be set.
Oh, yeah, just bring the form by or stick it in the box outside my office.
For sure.
I'll sign it.
Thank you.
I know, me too. Yeah. I know.
Cold parties.
Mind signing the
Sure.
pass me for the front? I have a pen for it if you need to.
Let me take this thing out of my, oh, I gotta shut this off.
Oh, fuck.